Walter here. A report came out this week, and I almost didn't believe it. The National Institute on Retirement Security just published their latest numbers. The median American worker, between the ages of 21 and 64, has $955 saved for retirement. Not $95,000, $955. Now, I should say up front, this isn't financial advice. I'm not your advisor, I'm not a licensed planner. I'm a guy who spent 30 years reading reports and connecting dots. What you do with any of this is your call. But that number stopped me, because I've been hearing a lot lately, on YouTube, on podcasts, everywhere, that the answer to building wealth is simple. Just compound. Just keep buying. Just be patient. And look, there's truth in that, real truth. I'm not here to argue with the math of compounding. The math works. But here's what's been eating at me. Nobody seems to be asking the follow-up question. You're compounding into what? In what environment? And what happens to your money's actual buying power while you're waiting those 8, 10, 15 years for the snowball to get heavy? That's what I want to talk about today, because I think there's a gap, a big one, between what the internet tells you about patience and what's actually happening to the dollars you're patiently stacking. If you stay with me to the end, I'll show you a piece of math that changed how I think about my own saving strategy, genuinely changed it. And if this kind of thinking helps you see things a little clearer, subscribe. I put out a video every day because I think this stuff matters. So let's start with what everybody agrees on. Compounding is powerful. It is. I've seen it work in my own life. I started putting money away in my late 20s. Not a lot, not consistently at first. And by the time I was 45, the early stuff had done things I genuinely didn't expect. It works. I've also seen it work for other people, ordinary people, not traders, not hedge fund guys. People who just kept going. The idea is simple. You put money in, the returns on that money earn their own returns, and over time, the growth starts doing more of the heavy lifting than your actual contributions. There's this concept floating around right now. I keep seeing it in videos, on Reddit, everywhere, called the 843 rule. The idea being that the first 8 years of investing feel slow, the next 4 start building momentum, and the last 3 years of a 15-year run is where the growth gets almost ridiculous. And the psychology of that is correct. I don't love putting exact year counts on it because markets don't read your calendar. They don't know you're in year 7. But the principle? Yeah. Early compounding feels like pouring water into the ground. Then it feels like something is happening. Then the ground cracks open and there's a river. That's real. And the advice that goes with it? Pick a simple index fund, automate your contributions, stop checking the balance every day, don't sell when it dips. All of that is solid. I'd give that same advice to my own kids. I have given that advice to my own kids. But here's where I start to get uncomfortable. And I mean that, uncomfortable, not panicked. There's a difference. Most of the compounding advice I see treats the dollar like it's a fixed thing. Like $1 today and $1 15 years from now are the same object. They're not. And right now, as I'm recording this, there's a $5,000 piece of evidence sitting on my screen that proves it. Gold is trading right around $5,000 an ounce, give or take. It's been dancing right on that line for the past week or so. $5,000 for 1 ounce of metal. Now, I remember, and this is going to date me, I remember watching gold cross $1,000 back in 2009 and thinking that felt extreme. I remember it crossing $2,000 during COVID and having a long argument with a buddy of mine about whether that was the top. It wasn't the top. And I want to be clear, I'm not saying gold is the answer to everything. I've got complicated feelings about gold, and I'll get to that. But gold at $5,000 is not just a number, it's a message. Gold goes up when trust in the system goes down. When people, and I mean big people, central banks, sovereign wealth funds, start feeling less confident about the currency they're holding, they buy gold. China's central bank has been buying gold for 15 straight months now. 15. That's not a trade, that's a strategy. So when someone tells you to just put your $200 a month into an index fund and wait 15 years, they're not wrong about the compounding. But they might be ignoring what's happening to the thing your index fund is priced in, the dollar. Bear with me here, because this is the part most people skip. The CPI numbers came out 3 days ago, Friday the 13th, funny enough. January inflation came in at 2.4% annually. That sounds pretty tame, right? And the headlines all said, inflation cooling. Okay, but look underneath. Shelter costs are still running at 3% year over year. Food at home, groceries, the stuff you actually buy every week, up 3.1%. So the things that eat your paycheck, housing and food, are running hotter than the headline. And that headline, 2.4%, that's the government's measurement. There's a whole conversation about whether CPI actually captures what real people experience, but I'll save that for another video. The point is this: even at the official 2.4%, inflation is compounding too. Wait, actually, let me back up, because this part matters more than I initially thought. I was sitting at my desk last night, couldn't sleep, my dog kept pacing around the house for no reason, and I pulled up a calculator. I wanted to see something specific. Let's say you're that person putting in $237 a month. That's a number I keep seeing used as an example. And let's say you get, a 10% average annual return. That's roughly what the S&P has done historically, and the S&P closed last Thursday at 6,836, so it's been a strong run. After 15 years, nominally, you'd have somewhere around $95,000. Maybe a little more, maybe a little less, depending on the sequence. Sounds great. That's real compounding. But now run that same number through a 3% average annual inflation rate, which is actually lower than what shelter and food are doing right now. Your $95,000 has the purchasing power of roughly $61,000 in today's money. You didn't lose any dollars, you just lost about a third of what those dollars can buy. And nobody told you that while you were being patient. This is the part that drives me nuts. Not because compounding is a lie, it isn't, but because the conversation is incomplete. It's like someone teaching you to swim but not mentioning the current. Yeah, you're moving your arms, but the water's moving too. I made a version of this mistake myself. Back in 2011, I was heavy into equities. Had a nice run coming out of '09. I was feeling smart, which, by the way, is usually right before I do something dumb. I was laser focused on my nominal returns. The chart went up, I felt good. And I completely ignored the fact that the Fed was running quantitative easing at full speed, gold was screaming higher, and the purchasing power of every dollar I was making was quietly eroding underneath me. I didn't lose money on paper, but I didn't get as far ahead as I thought I was. And that's a subtle thing, but over a decade, it's not subtle at all. Now, here's the thing. I talked about this about 3 weeks ago on this channel. I did a video about the real rate of return versus the nominal rate. Some of you in the comments told me I was overthinking it, that the market always goes up and inflation always comes out in the wash. And fair enough. The counter-argument here is actually pretty strong. I want to give it its full weight because I think it's important. The bull case goes like this. Over the really long term, 30, 40, 50 years, equities have outpaced inflation by a wide margin. The S&P 500's average annual return since 1957 has been around 10.5%. Inflation has averaged something like 3 to 3.5%. So you're still netting 6-7% real. That's real wealth creation. And that's true. The data supports it. If you zoomed out far enough, the person who just kept buying and never sold almost always came out ahead. I respect that argument. And honestly, for somebody in their 20s or early 30s with 40 years ahead of them, that might be enough. Just keep going. Don't overthink it. There's also the argument that gold doesn't produce anything. It doesn't pay dividends. It doesn't earn revenue. Warren Buffett has made this point 100 times, and he's not wrong. An ounce of gold today will still be an ounce of gold in 30 years. It doesn't compound. It just sits there and reflects what's happening to everything else. So if you're choosing between gold and equities for a 40-year hold, historically equities win. I'm not going to pretend otherwise. But here's the piece I think they're missing. That 40-year average smooths over some really rough patches. There was a stretch from 2000 to 2012 where the S&P went nowhere in real terms. 12 years. If you retired in 2008, your compounding didn't save you. If you needed that money between 2000 and 2003, the math looked very different than the 60-year average. And right now, I'm not making predictions, I don't have a crystal ball, but right now the Shiller-Cape ratio is near historic highs. Motley Fool just ran a piece on Friday saying history suggests the S&P could face a significant pullback in 2026. Partly because midterm election years tend to produce corrections 70% of the time. I'm not saying that's guaranteed, but I am saying that just be patient hits different when you're starting from elevated valuations. And this is where gold becomes more than a shiny object to me. This is where it connects to your retirement account, your monthly savings, your actual life. See, gold at $5,000 isn't telling you to sell everything and buy gold bars. That's not my read. My read is that gold at 5,000 is a thermometer. It's measuring something, the temperature of trust in the dollar-based financial system. When that thermometer is rising this fast, gold is up over $2,000 per ounce from a year ago. Just think about that for a second. It's telling you that big, serious money is hedging. They're not betting against America. They're buying insurance against the currency losing value faster than the official numbers suggest. And if the big money is doing that, shouldn't you at least be thinking about it? Not panicking, thinking. I had coffee with a friend last month, guy who's been in wealth management for 20 years, and I asked him straight up, how many of your clients have any inflation protection in their portfolio? He laughed. He said maybe 10% even know what that means. The rest are in a target date fund, maybe some tech stocks they heard about, and they haven't looked at it in 2 years. These are people with 3, 4, 500,000 in retirement accounts, and none of it is designed to survive a period where the dollar loses purchasing power faster than the official number suggests. That scares me more than any stock market dip. I was going to say this is a new phenomenon, but honestly, it's not. This is the same pattern from the 1970s. Stocks went sideways in real terms for over a decade. Gold went from $35 to $850. People who only compounded into equities during that stretch got hammered by inflation. Their account balances went up and their standard of living went down. People who had some exposure to hard assets, gold, silver, real assets, they kept up. Not because they were geniuses, because they were diversified in the right direction at the right time. Now, silver, I should mention silver because it's been absolutely wild lately. As I'm recording this, silver is around $78 an ounce, which sounds high until you realize it was pushing past $120 in late January before a massive sell-off. I mean, the thing lost almost half its value in days. Treasury Secretary Bessent came out and said that crash was driven by speculative trading, particularly out of China. Silver dropped almost 50% and then bounced back above 80 before settling here. I'll be honest, I don't love silver at these levels for someone just starting out. It's volatile in a way that can shake you out of your position faster than you can process what happened. I got burned on a silver play back in 2015, thought the setup was perfect, thought I was being clever, and it just sat there and bled sideways for 2 years while I waited for a move that never came. So I hold my opinions about silver loosely, but the fact that silver nearly tripled from a year ago, and gold is up over $2,000 an ounce in 12 months, that's telling the same story, just at different volumes. Money, serious, institutional, sovereign money, is looking for somewhere to go that isn't just paper promises. That's not conspiracy. That's the market talking. So what do you actually do with all of this? I don't tell people what to buy, you know that. But I'll tell you what I'd be doing if I were sitting where a lot of you are sitting, in your 30s or 40s, trying to build something real, putting a couple $100 a month away, wondering if it even matters. First, keep compounding. I'm serious. Don't let anything I've said today make you think saving into a broad index fund is a bad move. It's a good move. It's probably the best default move there is. If you're putting money into something like a total market index or an S&P 500 fund through your 401k, keep doing that. If you've got a streak going, protect that streak. The behavioral part of this, showing up month after month, that matters enormously. That's the part the compounding videos get right, and I want to be clear that I agree with them on that. But, and this is my second point, understand what you're doing. You're compounding nominal wealth. Track it, be proud of it, keep the streak alive. Just don't confuse the number on the screen with what it'll actually buy you in 10 or 15 years. This year, for instance, the 401k contribution limit went up to $24,500 if you're under 50, $8,000 more if you're over 50. And if you're between 60 and 63, there's a new Secure 2.0 catch-up that lets you put in an extra $11,250. If you can max those out, do it. But also know that even maxing out a 401k over 15 years might not give you the purchasing power you think it will unless you're thinking about what's happening to the dollar alongside it. Third, learn what your real return is. This takes 5 minutes. Take whatever your portfolio returned last year. Subtract the inflation rate. That's your real return. If the S&P did 10% and inflation was 2.4%, that's a real return of about 7.6, solid. But if inflation climbs back toward 4 or 5, and we've seen how fast that can happen, we lived through it 2 years ago, that picture changes fast. Get in the habit of thinking in real terms. Write it down somewhere. Put it next to your nominal return. Compare them. It changes how you see everything. Fourth, and this is the one most people skip, Consider whether your portfolio has any inflation hedge at all. I'm not saying go buy gold coins, right? I'm not saying drain your 401k and fill a safe deposit box. That's one option for a small slice of your savings, but there are others. Gold-backed ETFs, commodity funds, TIPS, Treasury inflation-protected securities, which adjust with the CPI. Even real estate, if you're in a position to own property, acts as a real asset. The point isn't to go all in on any one thing. The point is to ask yourself, if the dollar buys less next year than it does today, and gold at 5,000 is suggesting that's where we're headed, does my savings plan account for that? Most people's answer is no. Most people are 100% in equities, maybe a target date fund, and they've never thought about it once. I know because that was me for a long time. And I wish someone had grabbed me by the shoulders in 2006 and said, Walter, where's your hedge? Here's what I keep coming back to. That $955 median savings number I mentioned at the top, that's devastating enough in nominal terms. But in real terms, adjusted for what those dollars actually buy, it's even worse. And the people with 40,000 saved, the ones who are trying, who are showing up every month, if they're not thinking about purchasing power, they could compound diligently for 15 years and still end up short. Not because they were lazy, not because they quit during the boring chapter, because nobody told them the ruler was shrinking while they were measuring their progress. And that's what gets me about this whole compounding conversation. It's not wrong, it's incomplete. It's like a doctor telling you to exercise but never mentioning diet. The exercise is great, you should do it. But if you're eating garbage the whole time, the results won't be what you expected. I think about a conversation I had with my daughter last year. She just started her first real job, and she was excited because her 401k had crossed $10,000. And I didn't want to crush that excitement, because she should be proud, she should keep going. But I also told her something my dad told me, which is, the number isn't the goal, the purchasing power is the goal. The number is just how you keep score. Make sure you understand what game you're keeping score in. She looked at me like I was speaking another language, but she'll get it. Give it time. And look, I want to end on something that might sound strange coming from a guy who just spent 20 minutes telling you to think harder about your money. The most important thing is still to start. If you're in that 54% of Americans who have nothing saved, and there's no shame in that, life is expensive and the system doesn't make this easy, the most important thing you can do is put something aside, anything. The habit matters more than the hedge. You can refine your strategy later. You can't compound what you haven't started. But for those of you who have started, who've been at this for a year or 5 or 10, who are doing the right things and wondering why it doesn't feel like it's working fast enough, I want you to think bigger, not harder, bigger. Think about what your money is denominated in. Think about whether the unit of measurement is stable. Think about what gold at $5,000 is whispering to anyone willing to listen. Because compounding is the engine, I believe that, but purchasing power is the fuel. And right now, that fuel is getting thinner. And look, I could be wrong about some of this. I got burned once before thinking I was smarter than the market. Back in 2015, I was convinced silver was going to run because the fundamentals looked perfect, and instead it just sat there and did nothing for 2 years. Cost me time and opportunity. So I hold my convictions with open hands, but I don't think I'm wrong about the basic principle. Compounding into a depreciating unit of measurement without any awareness of that depreciation is like running on a treadmill and calling it a marathon. You're working hard. You're just not going as far as you think. The good news is that this is fixable. You don't need to overhaul your whole plan. You just need to add one question to your process. Instead of just asking, how much did my account grow, also ask, what can this buy me that it couldn't last year? If the answer is about the same or less, that's your signal to think broader. I'd love to hear your take on this. Do you factor inflation into your compounding math? Or do you think I'm overcomplicating something that should be simple? Drop a comment. I read more of them than you'd think. And the people who push back on me the hardest are usually the ones who make me think the most. Stay sharp. Protect what you've built. I'll see you tomorrow.